that has been the big, almost surprise of the year, is how what we thought would be the major crisis didn't really turn into anything at all.
I think it could actually be a year where we could top out. I think we're going to see more volatility all of a sudden.
We're living in a world where Nvidia is bigger than Japan in the all-country world index, but it's the size of Germany and France combined, or whatever. It's very hard to escape the US, whatever you do.
Welcome to IG's Outlook for 2026, a preview of the year ahead with Mr. Axel Rudolph and Chris Beauchamp. Welcome, gentlemen.
Thank you.
So the shape that this is going to take, we're going to go through 5 areas. The first, what are the macro trends at this moment in time as we go into 2026? Second of all, it is the monetary policy. What are the effects that central banks are going to have on the year ahead? Third, what stocks do we think are going to lead the market, or is it going to be sectors like very much AI did this year? Fourthly, we're going to look at any mega themes that may come out of the woodwork or that are brand new to the market dynamics. And then lastly, what are the risks? Is there any crashes on the horizon or surprises that we could see ahead of us? But first of all, gents, why don't we look back to 2025? What were some of your memorable moments? Chris first.
Well, it's got to be a year that still surprised everybody, I think, because you came in to the year with US exceptionalism on everyone's lips, and that kind of set you up almost for a bit of volatility, perhaps not in quite the way everyone expected.
Yeah.
But we knew there would be, I think, something to do with tariffs, and it was the magnitude that caught people out. What has then caught people out in the other direction is how quickly everything seemed to recover. And the market took this blow and then just seemed to shrug it off. And US indices ended up the year another double-digit year for US markets. The dollar was down, yes, but it started to recover. But that has been the big, almost surprise of the year, is how what we thought would be the major crisis didn't really turn into anything at all.
It was a panic attack rather than a heart attack.
Yes, everybody was the panic hand that I think Trump said earlier in the year. But you had that, he had that, and then you obviously had a year that saw Iran and Israel exchanging missiles in a way that people thought would mark something much more serious. And yet that didn't happen either. And oil prices continued after an initial shock. They then continued to fall again. So it was almost the year that everything carried on as we expected, just not quite in the way we thought it would, if that makes sense.
A bit off script.
Yes.
Axel, what about yourself?
Well, I got actually caught out by this because I looked really, really smug at the beginning of the year, as you well know, thinking that something like this could happen with regards to tariffs, markets could come off, but I didn't see the recovery that we saw, and to the extent we saw it happen in 2025. So that really, really surprised me, and I think a lot of market investors as well, because most of the rally at the beginning was actually driven by retail investors. It wasn't the funds. The funds were much more cautious, basically, yeah. And they're now playing catch up. So it'll be interesting to see whether that dynamic will continue into 2026 or not.
I think that was what was particularly interesting to me was 2021, we saw the GameStop meme frenzy come through, and retail investors thought that they were, the new kings in town, and they got an almighty slap down in 2022. But this year, they really taught institutions a lesson. And that April sell-off, they held their bags and they continued to buy all the way up. And I don't think institutions really got involved until there would already been a 15% rally.
Exactly.
No, and if you look at positioning, it's still not overly, certainly not euphoric. People aren't piling in the institutional level. They're still, positioning remains relatively close to neutral, I think it's fair to say. And that after the shock of April and May, it takes time for them to sort of go back into the US, and that's still being worked out, really.
And you've also got some investment banks now saying that next year we will see no longer double-digit gains because they cannot see a scenario where we would have a fourth year of double-digit gains in a row in the US.
Yeah, well, talking about double-digit gains, another double-digit return for Trade of the Week. Axel Rudolph, well done.
Well, thank you. And Chris, we did it together.
Well, I think it was mostly yours, but...
Tell us the stats behind it, because you were up over 30% at one point.
Yes, 33, and then I had a really, really bad losing run, which happens. But yes, I mean, that's the thing, basically. You need to be aware that, getting 5 or 6 or even 7 in a row wrong happens. It's just part of trading or investing. But the good news is, if you look back the last 7 years for IG, on average, we've made 19% return, risking 2% per trade. So you can make double-digit returns, high double-digit returns, risking just 2%. And a lot of investors or traders especially tend to overtrade and also trade too big size. So you need to make sure that you're keeping it simple, small, and consistent.
That is a huge lesson for everybody to take away. What would you say the lesson that you've learned this year in particular that you could take into 2026, Chris?
It's never underestimate the market. And that sounds like a very obvious thing to say, but people overthink so much. And that has come to the fore again this year. Here are the reasons why the market will go down and it will continue to. The number of people that said, May was just a bear market rebound and it's going to go lower from here. The April low wasn't the low. It teaches you humility once again, I think. Just because it's gone up a lot doesn't mean it can't go up anymore. And there are fundamental reasons behind it. I think that's the important thing. Double-digit earnings growth is what's fueling this market. And that's not some kind of made-up number. That's real earnings being reported by US companies.
And Axel, the big lesson of the year?
Well, as Chris said, I was one of those who thought that April wasn't going to be the low. And it cost me. And I was clearly wrong. I should have just followed the chart. And for once, I looked at the fundamentals as well, which I don't normally do. And yes, I mean, as Chris said, you can come up with all sorts of scenarios, but you should never trade what you think is going to happen, but just follow whatever the market is doing.
Yeah. Turning to the macro outlook, as we're going into 2026, do we even know where we are? If you wanted really put an estimate on growth, if you want to know what inflation is, if you want to know what unemployment is, we don't know.
No.
So how can we feel confident going into 2026?
It makes sense to be cautious because the picture is certainly incomplete and the government shutdown continues to reverberate. As we go into January, we're still playing catch up with the data, as is the Fed. And so there's a concern that we're not seeing the full picture, which may, I think, lead to some volatility as we go into this year. But you have to look at the fundamentals. We're still waiting for that US recession that was predicted 3 years ago that has yet to arrive. And that feels like I'm tempting fate by saying that. But the data is okay. Jobs growth has slowed massively in the US, but is that just a hangover from COVID? Potentially. I know you're probably skeptical on that point, but I think and they talk about the K-shaped economy and everything's all been driven by AI. But the fundamentals probably could look a lot worse, shall I say, rather than saying that everything is rosy. Everything clearly isn't. Concerns about inflation and consumer spending remain, but I think it could look a lot worse after what we'd seen in the first part of this year.
So not so much a Goldilocks scenario, but maybe we're going into another soft landing. How many soft landings do we want to have?
So if you have is it a soft bounce after the soft landing? But you have to say that the US economy has weathered this storm very, very well. Maybe because they're not paying the full impact of tariffs, maybe because it has yet to be seen. But overall, if you'd asked people in the depths of April, will we be at this point now in terms of the economy, the answer would have been no. So I think that's also the important lesson to remember.
And Axel, we've been waiting for inflation to come through, haven't we? Jerome Powell's been waiting, and it just isn't showing up yet. Have we got away with these tariffs being implemented, or have they just not had the chance to come into prices yet?
So personally, I am of the latter view because I just cannot see these very high tariffs. Let's not forget, we're not talking about 5 or 10%. I mean, some of these tariffs are huge, not having an impact down the line. And yes, I mean, I would have thought that it would have shown in the data until now. It's not the case. But I do think that we will see inflation creep up again because of these tariffs, and probably in the first quarter of 2026. But I've been wrong all of this year, so I put my hands up.
Chris, what about the health of the consumer? Because if we're worried about unemployment, are we worried about the ones who are consuming and therefore generating the revenues? Or are we worried about the ones that perhaps don't have as much as a marginal effect on the economy?
Yeah, I think we are worried about consumer spending. It's about, 70% of the US economy as a whole. So I think it's going to be closely watched. Are these job losses really beginning to feed through into the broader economy? Will the Fed continue to cut rates enough to offset that? I think because there's a certain sense there will be a changeover of Fed leadership this year as well.
We'll come on to that, don't you worry.
Yeah, and I think that's going to be the one to watch. How well is consumer spending holding up? We should be concerned maybe that people don't have the money to spend. And Trump might say prices are down, but even Fox News is prepared to say no, prices are up. And if you look at the RBA, as we just come into the last week of December, they've had to stop their cutting efforts and indeed are probably signalling that they're going back to hiking rates. You have them hiking rates, you've got the Bank of Japan hiking rates. So consumers around the globe may well face yet another painful year, really, where they're not seeing that growth in their income that they'd like to see. And that will continue to crimp demand to an extent.
And Axel, what about the government spending side of things? Has gold gone up this year so much, which I think must be one of the big surprises to everybody? Is that because of the worries around debt, or is there something else pushing it? Is it the technicals?
Well, the technicals are driven by the fundamentals, let's face it. They're just reflecting what's going on between buyers and sellers, demand and supply. But I think more than anything, it's the fact that Donald Trump, as US president, has been extremely aggressive with other countries such as China, and these countries may in the future want to move away from a US dollar denominated global economy, and therefore they need to have other means of basically financing the debt and also forth, and basically they might need to move away by buying gold. So the demand for physical gold, especially by the People's Bank of China, has been absolutely huge this year. And it's not the only central bank who's been buying up gold very aggressively. So I think that is also playing out at the moment.
So you think it's the diversification of reserves that are being moved away from the dollar because of Trump? And I guess that was the follow through from that tariff fiasco, wasn't it? The put tremors under the confidence in the dollar.
Yeah, I think it was a worry that the US was going to throw a lot of this away. Now, some of that is reversed, I think, because there isn't really an alternative. I think even that people would like there to be an alternative, but there isn't. And these kind of shifts don't happen overnight. They take a long time. So I think that's another key element, is people will just have to continue to live in a world where the US sets the economic weather. And I think this is a realization that people are coming back to as the year ends. We've gone from 12 months ago, as I said, US exceptionalism, back to sort of not exceptionalism, but a realization that everything else flows from what happens there. And that might be an uncomfortable truth for many, but it is still the fact of the matter.
Looking towards the monetary policy then, is there a worry around the new Fed chair, or are the questions around the Fed independence irrelevant anyway? Because it's not irrelevant, because it's not necessarily the government that dictate what the Fed do, it's markets.
Yeah, and Fed independence has always been a convenient truth. How real it was is another question, I think. But the post-crisis era is certainly drawn to an end, I think, and now you're seeing a much more interventionist approach from the government. Obviously, we have a new Fed chair coming in. We think it's going to be Kevin Hassett. But basically, he's dropped hints large enough. And he is a man who thinks interest rates should come down, and there is a desire in government to, as they say, run it hot, which has implications for inflation. But if it means that you have a Fed that is prepared to loosen policy just to get the economy rocketing ahead because they think it works for most people, because it certainly doesn't hurt the administration ahead of the midterms, then that will be the question of how far does this go, and what will inflation do in that kind of environment? So that will be key. How much the board will look to rein in the Fed chair, because he's only one person amongst a whole board. And once the scramble to be Fed chair is over, will we see independence start to reassert itself? And that's been the trend of the last few months, has been that there are more dissents now in Fed decisions, much like what we've seen with the BOE than has been the case. The Fed has been this consensual central bank for so long. Maybe it's a good thing that these policy dissents are beginning to emerge.
And what would your expectation be for how many rate cuts, assuming we get one in December?
Yeah.
How many rate cuts in 2026?
Well, the question is, how, do they all arrive all at once? If on this first meeting, does he manage to persuade them? Just, I think he said he could see an environment where you cut 2% in a day, or whatever it was, 2 percentage points, which probably wouldn't be the best thing because you have to move slowly in central banking. I expect you'll see we go down to 2.5%, maybe, or maybe a fairly aggressive move on that front, because he thinks,
4 cuts.
I think 4 cuts is, well, we assume that it'll all be 4 of 25 basis points, I suppose, will be the base case, really.
Okay. Now, Axel, if we do see 4 rate cuts, if we even see 3, that's the opposite of what the Bank of Japan are doing. What have you seen this year in the Japanese yen? And with all the change at the top in Japanese leadership, what do we expect from there? Is that going to be the wild card that we watch for?
I certainly think so. I mean, right now, if you look at the debt-GDP ratio in Japan, it's more than twice of what it is in the US or in the UK. We are above 100%, but around the 100% mark. They are over 200%. So the question is, how can they keep on financing this debt now that they're in an environment where they have to hike rates? And also what you're seeing is the carry trade unwind, where investors were basically buying cheap yen because the yield was 0 or negative. Buying currencies elsewhere and financing that with cheap yen. That's unwinding now. So what we'll probably see going forward in 2026 is the yen appreciate, also because interest rates are rising in Japan. And the question then is, because Japan is such a big bond market in the world, whether that increase in rates is sustainable, because what's happening there is a small increase in the yield leads to a huge amount of extra money they need to spend on just paying off their debt. So basically, bondholders would want to have a bigger yield on the money they're lending to the Japanese economy, to the central bank, and therefore that I think is also going to hurt exporters. We know Japan is a net exporter, the largest in the world, and obviously, if the yen is appreciating, then exports will become more expensive. So all of that could have a detrimental effect on Japan and also on us globally here. Yeah. The big difference, though, is with the US or the UK, that most of the debt in JGBs is held by the Japanese domestically. So the Bank of Japan keeps on buying, I think it's buying half of its debt. It's just the Bank of Japan. But if it now normalizes that relationship and basically buys less, again, that will put pressure on yields in Japan. So I think that's why recently we looked very, very closely at the 10-year JGB issuance, whether people were still buying the bonds there, because that in the future may change a bit, and it could have global implications.
Chris, if the carry trade is dead, that blows your bull theory out of the water, doesn't it?
Why?
Carry trade, come on.
But it's not the only thing. It hasn't been the only fuel that drives markets. Ultimately, stock markets are driven by earnings and by economic growth before everything else. And as we've seen this year, US earnings remain very, very strong. Yes, 13% on quarter if you include the whole S&P 500. But if you take out the Mag 7 or the biggest ones and talk about the S&P 493, then it's something like 10.9%. So it's still a double-digit figure. That isn't a carry trade thing. That's not being fueled by that. That's simply the earnings.
24 times earnings multiple is leverage.
But we've talked about this before. 24 times earnings is a reflection of the quality of the earnings you're getting, I think, far more than, and I know we've batted this back and forth endlessly this year. You get the FTSE at 15 times, you get the DAX at 17 times, and the S&P at 24 times or whatever it is. But because the profit margins at US firms are so much better and they continue to improve, that is why people are saying, okay, that's expensive, but I'm prepared to pay that because I think I'm getting the quality that goes with it. And that doesn't rule out that we could have volatility. And Axel and I discussed, well, when do you get the next bout of volatility? Because you had one, where are we now, 9 months ago, 8 months ago in April, 25%, whatever it was. How long before the next one arrives? Every year, the average inter-year drawdown is like 15%. You get one of those a year on average. Yeah. The curious thing about the last 6 months has been that you haven't had that. 5% has been your limit, essentially. So I think if you're an investor and you're looking into 2026, if you got, I don't know, within the first half, another 15% sell-off, which you probably should anticipate, what do you do in that environment? Do you run for the hills, or do you try and screw up your courage and wait for it, give you that sell-off to perhaps increase your exposure or renew your exposure?
So if we were looking at a portfolio allocation then, how much would you have sitting on the sidelines because you're fairly confident a 15% sell-off could come?
I think you should assume it will happen every year, I think, and sometimes it's much bigger, sometimes it's less. I think, again, I've talked about this before, about 2017 is my kind of roadmap for the second half of this year, of how quiet that was and how it pushed higher. And as we moved into 2018, you had actually January and February saw continued gains, and then it came off. And actually then it continued to push higher for most of the rest of the year. And the back end of the year we can talk about later. But there was a resumption of volatility. It got noisier. And that is what I think you should talk about, particularly for 2026, is that we should assume there could be some kind of volatility. You should always prepare for these kind of things, even if they don't happen.
How much earnings growth do you think is priced in at the moment?
That's very hard to say, I think. At the moment, I still think we're looking at fairly optimistic earnings growth. I think it should. US has matched those optimistic forecasts over the last sort of 2 or 3 quarters. Mm-hmm. So I think it's always the risk that you get a bit of a stumble. Say it drops back towards 9 or 8, that could imply a substantial repricing, at least in the short term.
Where do you think the earnings growth comes from? Obviously, this year it's been that CapEx boom in the AI sector. Do you have a feeling for where earnings growth could come from next year?
Well, I don't think that trend is over, to be honest. Yes, we're getting, like the general market, towards a perhaps end phase of a healthy bull market, which we had for many years. And perhaps we could see a more volatility, as Chris just said, because of that. Good question. I mean, at the moment, as Chris said, a lot of the larger US companies are still beating earnings, and they have solid growth. They still have cash, a lot of them. So why shouldn't things continue the way they have? Maybe there might be an upset and we get a disappointment at some stage, but it might happen down the line in the third or fourth quarter of next year. So I see us making new record highs, not just in the US, but probably in Europe as well. The FTSE probably hitting that 10,000 mark that you've been waiting for.
Absolutely. And
also Asian markets making new highs in the first few weeks. The question for me is, are we then seeing what we saw a few years ago? I can't remember exactly which year, but where in February you get this decline then, before then going higher, or is that it? Is that the sort of 2008 scenario where you suddenly form a top and you're coming off? But for the time being, if you look at charts, we are still in a bull market. We still have a series of higher highs, higher lows. And as long as we stay above the November lows in all of these markets, the trend is your friend. That's all I can say, really.
I think that is the February that Chris was referring to, 2018, Volmageddon. And we were down 9% in 24 hours. And that's the kind of scenario that you do have to keep that powder dry from. Yeah. So I will push you on how many percentage do you think should be in something, not necessarily cash, but in along with IG, you know, the cash return. Yeah. The interest rate on cash is quite attractive. Yeah, exactly. I think you have to always keep a portion because you want to for the opportunities that arise. I think if you just say some of our portfolio guys, they look at sort of 10%, perhaps a little bit more, just to have those opportunities around. And you have to remember the midterm years as well.
tend to be the 4-year presidential cycle that the US goes through. Midterm year is often the weakest year. Not necessarily negative,
Right.
but it is often the weakest year. And then you see, because 2022 was a midterm year as well. So history does kind of repeat itself in that sense. So yes, I think you have to not always be all in all the time. And you understand the reluctance of people to say, well, the market's at record highs. Something has to happen from here. Well, not necessarily, but it's prudent to look at it that way. Remember, the US is still 66% of global market cap or whatever. The figure is in that kind of ballpark. So the weather is still set by them. You're living in a world where Nvidia is bigger than Japan in the all-country world index, where it's the size of Germany and France combined or whatever. It's bigger than the FTSE 100, which is 2.5 trillion market cap. So it's very hard to escape the US, whatever you do.
And of course, tech is 40% of that S&P 500, even bigger in the NASDAQ, obviously. What other industries would you be confident in? If we got industrials and energy and financials, what would you be looking towards for leadership?
Financials have done very, very well. And I think that's a reflection. If you think the US is a reflection of the US economic strength, if you think the US economy is continuing to grow, they will be another way to play that. Particularly, yes, rate cuts will hit their net interest margins, but you're expecting that to be compensated for by increased corporate activity. So that's another sector to consider globally. Energy as well, I think, is particularly interesting. Given the weakness in oil prices, maybe there's still a case for more of an interest in renewables. Because if you look at the evidence from Trump's first term, well, actually did quite well renewables compared to oil stocks because of the focus on there was increased production which drove down prices. So they did quite well. So that's another area to consider. And nuclear as well, because I think that's an issue that's not going away here in the UK as well as in the US, that people have to ask questions about where the power supply will come from, particularly.
Indeed, both Rolls-Royce and Scottish Southern Electric having great years. SSE expanding into that renewables and even taking on debt and being rewarded for their strategy there.
And defence, of course, as well, because the big winner of 2025, Rolls-Royce, when have we ever seen an aerospace company do those kind of returns? And it's dangerous to assume we'll do the same thing again, because as with a lot of these defence names, a lot of good news is being priced in. But if they have a period of weakness, if you're living with headlines where European defence spending is rising, US defence spending continues to go up, and globally it's going up as well, Japan wants to spend more, then I think weakness in those names in the short term probably sets you up for opportunity in the longer term.
Axel, a lot of that defence spending started with Germany, changing those fiscal rules. What do you think? Was that one of the surprises of 2025? And how does the German parliament go through into 26?
It was definitely a surprise for many. And I think Germany is just going to head in the same direction and try to, for the first time since the Second World War, have a more prominent place on the world stage with regards to its military. It's for constitutional reason has been in the past prevented from doing so, but I think the German government is trying to change things and make sure that the situation in Ukraine cannot happen to NATO and Europe. So as we saw also with the, I don't know whether we should call them skirmishes or whatever's going on with the drone incursions into Polish territory and things like that, we could see more of that. I do hope we're going to see a peace agreement between Ukraine and Russia, but even then, I think NATO is going to make sure that we can stand on our own feet, and Germany very much at the forefront of that with France, and that we don't need support from the US, and we could, if the worst came to the worst, actually defend ourselves without the help of the US.
The start of the year, it looked like you were also getting a huge benefit in the DAX from the end or pause of American exceptionalism. Does that continue into 2026? Is DAX somewhere that investors should be looking?
I don't think it does. We saw it towards the first half of the year, sector rotation out of AI stocks, tech stocks in the US into the biggest economy in Europe, Germany, and the likes of SAP or even German car manufacturers at some stage recovered quite nicely after the tariffs. But I am not sure that what we've seen in the last few months, where we have had money being taken out of European stock markets again back into the US market, won't continue at least in the first quarter of 2026. So I think the current trade seems to be more on the lines of invest in the US, because as Chris said, you cannot not invest without US stocks in your portfolio. And therefore, I'm not sure that Germany is going to benefit from that going forward.
So we've touched on defence then, Chris. What about the other big themes that could be coming through? Energy transition, you've touched on there as well. Infrastructure, with the big data centre build out. Is there anything else that's on the horizon?
I think you're still looking at possibilities for energy outside of renewables, particularly, and commodities and mining is the other big story. I think if the infrastructure boom continues, and they talk about the need to spend more on infrastructure in the US and the UK and indeed elsewhere, there's that demand there for metals too, I think, and that should be an interesting one, because miners have seen quite a recovery. A lot of these solid global mining plays. M&A is still a factor, I think, in that sector as well. So that can't be ruled out for providing some interest as well.
Yeah.
But that could also create inflation once again. If you look at the copper price, for example, that's gone ballistic, hasn't it, in the last few weeks? Mm-hmm. And I think that trend is likely to continue also with other commodities. So if those become more expensive because we need them for the production of our goods, that will then again create input inflation. So
that's right. And that copper supply story is starting to come in. We've been waiting for it for years.
Yeah.
And now eventually it does look like supply is tightening, shown by BHP grasping for Anglo-American and failing to get them. Mm. So the mining sector, as you rightly say, M&A could stay prevalent. What about other M&A going into 2026?
Well, as we see with Netflix making play for some of its rivals in the space, it isn't going away, because I think there's a sense that with lower interest rates, people can be more adventurous in this. So I think you can expect it in a host of sectors, to be honest with you. IPOs as well seems to be a theme, because if confidence recovers, and it takes time for that confidence to recover after April and May, and then slowly the pipeline of IPOs is coming back. You've had obviously Prince's in the UK, that wasn't a fantastic IPO, but it certainly perhaps signalled a return of activity. We still talk about things like Shawbrook making a listing in the UK as well, and others that might join the market to revive that FTSE 100 market, FTSE 350 that has been quite moribund of late. So that's the other story as well, the M&A stuff and IPOs, which is a sign of animal spirits returning to markets as well after a bit of a knock in 2025.
Animal spirits. Axel, Rudolph, how have we managed to get through 45 minutes of this preview without mentioning cryptocurrency?
Yes, good point. I mean, cryptos, to the detriment of many who are holding them, haven't done so well, have they, since, I believe, what was it, September of this year?
Yeah.
And I believe I saw a stat recently that about 87% of the major 6 cryptocurrency holders are actually underwater with regards to where they bought them at. So the majority of people bought them at higher levels, and they're suffering, and they don't understand why, even though equity markets are trading close to their record highs. I mean, if you look at the Dow, for example, within 1% of its record high, why aren't cryptocurrencies doing the same? So what we're seeing there is we saw a lot of outflows from ETFs, and basically a lot of institutional holders also perhaps pausing in their purchases of cryptocurrencies, and therefore the demand at the moment is just not there to push Bitcoin back above $100,000, for example.
Did we just see too much too early? Were all the gains H1 weighted and there was nothing left?
I think it could be seen that way, because you had such huge gains earlier in 2024 as well. So these things you have to have these natural periods of retracement in crypto prices, and the pullback in Bitcoin since October has been nothing compared to what we saw in many previous years.
30%,
but you do 80% was kind of the expectation. I think there's almost that sense of people expect it to keep going down. I think we were almost looking at a capitulation moment, I think, in Bitcoin, really, because people were beginning to worry that there would be a lookout below and we go down to 70, 65.
But isn't it the petulant teenager that's grown up now? You've got ETFs,
Well, yes.
you've got institutions, you've got Vanguard investing in crypto now. So it's never going to go down 80% again, is
No,
it?
it probably isn't, but people I don't think have fully woken up to that fact, perhaps. You're still expecting Bitcoin to have these huge swings because that's all we've got to go on in terms of the data. But yes, as you say, because it's been institutionalized, if you like, I think I mean that in all senses of the word, then or captured, if you like, by institutions, it doesn't see quite the same volatility. So it doesn't interrupt the overall trend, but I think, yes, it's not quite the Wild West that it used to be.
Having said that, we've seen a purge in those investors who've basically used leverage to buy crypto. And I think those have now been pushed out of the markets.
Huge flush out, hasn't it?
Yes. And that's actually a healthy thing because, as Chris says, corrections are normal. So for me, as long as Bitcoin, for example, stays above the $80,000 mark, I wouldn't be surprised if we hit $100,000 again in the first quarter of next year. The question then is, can we actually exceed that and go back towards the highs, or we'll just bob along 100,000 for quite a while? But right now, the demand doesn't seem to be there.
Because it's just not meant to happen this way, is it? That you've got an asset that's correlated to the NASDAQ, it's correlated to gold, and those two have had fantastic years. So has the correlation broken? Has something else broken? Or is it just that the flush out of the leverage?
I think it would be easy to say the correlation is broken and that something else has shifted. I don't think it's ever that simple, really. I think nothing ever works all the time in markets. And simply saying Bitcoin must go up because the NASDAQ's gone up and gold's gone up, they tend to go up together. The key word there is tend to, because it can't happen all the time. We could easily be looking back in 6 months' time and say Bitcoin's at, I don't know, 140 for the sake of argument, and say, well, it was obvious that you should have bought it there and it was a brief dip in otherwise trend. And plenty of articles will be written along that lines, trying to be wise after the event and say, well, it was bound to happen this way. And then normality reasserts itself. So I think it's important to look at it both ways.
Well, seeing as you've made your first prediction there, then that does take us on to targets. Somebody reminded me yesterday, my target for year-end 2025 on the S&P 500 was 4,789.
Not quite there.
I was way off, very much wrong for December, but I will have you know that the S&P bottomed at 4,792 on the 7th of April. So just 3 ticks off.
Yes. So you had a good prediction in that sense. You were just slightly early.
I just didn't label it correctly.
No.
What are we thinking this year, Axel? The December 2026, where are we going to be looking at the S&P? Where are we going to be looking at the FTSE? And then what about the gold price?
Let's start with gold. And before I start, actually, I want to say that I don't believe in predictions, even though I'm a technical analyst, because you can take all the predictions by all the major investment banks in the world and put them together and then look at it at the next year and see that most of them are going to be incorrect anyway. So who am I to come up with predictions? But anyway, gold has been in a bull market, a very strong bull market. I don't think we'll continue to rise at the same pace, but I wouldn't be surprised if we do get towards $5,000. Why? Because basically there is this underlying demand by the central banks, several central banks, not just China. And also, if we were to see a market correction, the default play is usually to go into a safe haven such as gold. So even if we have a blip or even a bear market in equity markets, the gold price should rise further still. So I'm pretty bullish on gold still. And I think that will continue. Same with gold miners. I think they will obviously benefit from that rise in the gold price. So yes, 5,000 for gold. S&P, quite honestly, the next round number, I think that's the play to do. But then will we continue to go up or not? I don't think we're going to see another 2-digit rise this year, not 4 years in a row. I just can't see it with the midterm elections coming in the middle of the year. I think there will be a wobble for that reason. And then you talked to me about the dollar, is that it?
The FTSE 100.
The FTSE 100. The FTSE 100, 10,000, same thing as with the US basically, round numbers. We might go to 10,002, 10,003, but I can't see 11,000. I don't think, again, we're going to see another 17% up. That's quite rare. I actually can't remember when that was the last time that we saw something like that. I can't.
FTSE, no.
So you think it's going to be a year for traders then, by the signs
Definitely.
of it, not hold and...
I think it could actually be a year where we could top out. But I thought that of this year, and I got it completely wrong. So,
Well, we did top out for 6
But not-
weeks,
yes.
and then it went up again. So
but then again, you could say the same in 2000 when we had or 2020 for the COVID pandemic. But yes, I think we're going to see more volatility all of a sudden.
Chris, would you rather be in equities, bonds, commodities, or crypto?
I think you'd still broadly want to be in equities. I think if you're expecting to hold this year, I think you should expect it to be a bumpier ride for the coming year. I think that's the assumption you make here. However, the boring answer is the sensible one. It's the diversification answer, that you need a bit of everything to an extent on the basis that you don't know which will do best.
Okay.
So you have to have that degree of protection and volatility. You could say for 2025, you should have all been all in Rolls-Royce and gold and Nvidia, and you've done generally very well. You might have had an awful shock in about April, but you've done very, very well. But you simply cannot make that guess. If you look at the sort of heat map of what does well every year, what's your best asset class each year? Everything. It's a quilt of returns because everything, it just changes around. You cannot, with any seriousness, expect to get it right year in, year out. What I will definitely say is that there's a very high chance that there's a double-digit correction, but I could never tell you why. And it will always look obvious with hindsight. You could come up with a list of things to be worried about, and you probably have for the year, that you should have on your list to be concerned about and make sense to be concerned about. But that probably won't be the thing that causes it, because if you see these things coming, you can prepare for them.
Come on, let's hear from you. What could cause a 10 to 15% correction? Loss of faith in Hassett would definitely be the top three, I would say. Japanese carry trade we've touched on.
Besant leaves as Treasury Secretary for whatever reason. He gets fed up. That I think could cause a bit of a wobble because he's always seen as, I think this reputation has diminished this year because he's probably been wheeled out too much. But he comes across as the voice of sanity in the administration when he's not trying to punch Elon Musk and make everyone feel better about themselves. I think people will be worried if he was to depart, particularly. So that's one worry that you might want to have on your list for the year.
The Chinese coming up with a cheap chip alternative.
Yeah, and we had a bit of that this year with DeepSeek, didn't we? That they've come up with a cheap alternative to AI, and the whole thing's been undermined. And that went away very, very quickly, though it felt very serious at the time. Tariffs still have to be on your agenda. As we round off 2025, he seems to be picking another fight with Mexico and Canada over their trade agreement. So it could be another thing that blows up again.
And talking of China invading Taiwan, that would be an absolutely huge bear market signal.
Yeah.
And I know we've been talking about this for many years, but one day it may actually happen. Especially now that the Chinese Navy is bigger than the US Navy. And that hadn't been the case before. Their army, if you look at personnel, is bigger, much, much bigger than the US Army.
They've got a lot of drones.
They have a huge amount of drones, and yes, to the day, the U.S. military is still the most, probably the best equipped military that's out there with the best technology. But I think the Chinese are very rapidly catching up. And also, politically speaking, will Donald Trump risk another war now that he has? What was it, 8?
Yeah.
He stopped 8 wars, apparently, according to him anyway. If China were to do that, he may not. And if the Chinese know that, they might just invade Taiwan. So I think that's really a real danger. Also, the flare-up between Thailand and Cambodia. I mean, nobody really talks about it now because we don't really care, unfortunately, for them.
That's the market, yeah.
But if that spreads to the region, or if the policies that the US administration, applies around the world with regards to its trading partners, the tariffs, for example, on countries like Vietnam, pushing those countries closer to China, that might also change things going forward.
Yeah. Okay, so we know it's not going to be any of those things.
Yeah.
Still, Chris Beauchamp, the secret thing that's going to take markets down. Where is the S&P 500 going to bottom? What is the low point of the year?
Well, we talk so much about numbers. The key is the journey, isn't it? The direction of travel and how it gets there. Because it could end the year at 8,500, but it might have an almighty correction in the process. It could rally towards, where are we now? It could rally to, say, 7,400 by May. It could come off by 20% and then discover that it wants to rebound again. So I think it's the base case for most investment banks seems to be gravitating towards about 7,900, 8,000 for next year, which is, lo and behold, the 10% that you get on average every year. So there's not much. There are a few brave souls calling for sort of 14, 15% gains. I think Oppenheimer is one of the stronger ones. It just feels like because we've reached the end of the year, we have to make a prediction for what comes next. And that usually the market will do its own thing in its own time. And it will be fruitless to try and predict it because it gives you that. As humans, you look for that sense of certainty because it makes you feel better. But it's an illusion of control rather than actual control.
Where you do have control, though, is using stop losses. And I think 2026 will be the year where it's a good idea to have stop losses in place. Because if you get stopped out, if you have been long for a year or two, you will still be in a nice profit. But then you can take that cash and use it again once we have dropped those 15 or 20%, etc. If you don't and suddenly drop 30%, you might harm your portfolio. So I think it's very important to make sure that you know what risk level you're comfortable with, what drawdown you're comfortable with, and use this time before the end of the year to actually look at your portfolio and analyze it a bit and just say, okay, if this were to happen, I would scale out a bit, etc. Just be more careful, basically.
What I would say is beware, because everyone has access to so much information about it. I said beware of people particularly on social media who like to draw big arrows on charts. That's my other lesson in 2025. Because in April and May, there were a lot of people who put up a chart of the S&P and they drew a big arrow pointing downwards to, we'll go down to 3,000 or whatever. And then they didn't talk about that afterwards. So I think if you do get a big drawdown, which seems quite possible, just be aware of that. When you start to see these kind of, there's a less polite word for them, but that like to make these grand predictions about the world is ending, just beware, because it's very easy to fall into this. You shouldn't be blindly optimistic about things, but nor should you fall into too much pessimism. And I just think the brigade that like to draw these big down arrows on charts are probably due a bit of a good moment in the next 8 to 10 months.
Basically, what you also need to do is use reverse psychology always. What I mean by that is if everybody around you is scared, if the CNN greed fear index is at extreme greed levels for 2 weeks in a row or something like that, if the put call ratio is above 1, that's the time when you actually go in, when everybody around you is panicking. That's when you want to go long, and that's when you buy. But yes, just be careful, because you will be within this mass psychology at that time, and the press will be extremely negative. But that's the time, which is quite often the best one to buy into, to go back long again. Because the world doesn't end, and if it does, we're not here anyway.
Well, that seems like a great note to end on. Axel, Rudolph, Chris Beauchamp, thank you very much for joining us. It sounds like 2026 will be a year to be a disciplined trader. Let us know what you think in the comments below. Give us a like and a subscribe. Thank you very much for joining us. We'll see you this time next year.